Hi there. In this tutorial, we'll be learning about the basic features of bonds. Specifically, we'll be talking about maturity, face value, coupon payments, bond prices, and yield to maturity. And at the end, there will be some true and false questions for you to test your learning as well. So let's begin with the maturity. So to understand maturity, we need to think about the bond issuer and the bond investor. So first of all, the issuer can be the government, okay? Or it could be a corporation, okay, private corporation. So in the context of US, so the government bonds are called treasuries, and you can have treasury bills, so sometimes simply called T-bills, treasury notes, so T-notes, or treasury bonds, okay? And the bonds issued by corporations are, not surprisingly, called corporate bonds. Okay, so corporate bonds. And the way it works is that this is a mechanism for governments and corporations to raise money from investors. And each bond has a specific term. This is called the maturity. So for example, in this case, we have 10 periods, so it could be 10 years. So at the end of this period, the bond ceases to exist, and this is the point. Basically, the borrowed amount needs to be returned to the investor. We'll come to this in the next slide as the face value. And in terms of the differences between treasury bills, notes, and bonds, this is based on maturity. So basically, treasury bills have a short maturity, okay? Treasury notes have a medium maturity, and treasury bonds have long maturities. So for example, treasury bonds can be up to 10, 20, 30 years, okay? Right, so let's move on to the next fundamental feature, which is the face value. So for US bonds, this could be something like $1,000, for example, okay? So this means that you will pay as an investor a certain amount to purchase this bond, and if you hold it until the maturity, face value is the money you will get back, okay? Next up is coupon payments. So every bond will have the face value at the end, and some bonds will have coupon payments in the meantime until the maturity as well. So these are basically regular cash flows. And again, we can distinguish between two types of bonds here. So the first type is coupon bonds. So these are the ones that make regular coupon payments, but you can also have zero coupon bonds. So as the name implies, the second category, the bonds in the second category don't make any coupon payments. So you might wonder, why would you ever buy a zero coupon bond? The idea is that essentially you will pay a low price at the start, and if you hold it until the end, you will get the face value. But now focusing on the coupon bonds, like I said, these guys will make regular coupon payments, and these can be either fixed payments, okay, or variable payments. So some bonds will be variable coupon bonds, and the amount of coupon they pay will change from one period to another. So coupon payments could be, for example, annually, or they can also be semi-annually. So semi-annually means 2 coupon payments within a year. Okay. So for example, if this is a bond with semi-annual coupons, so these periods would represent half a year. Okay, so each period would be 6 months, and this would be actually a 5-year bond. Okay. Now, in the case of, so just to give you a more specific example, so let's say the face value is 1,000, and let's say the coupon rate is 10%. So if the coupon is paid annually, this means that each year you would earn a coupon of $100, or if it is paid semi-annually, it means that every 6 months you will get $50. So over the course of the year, in total, you will get $100. So for the semi-annual bond, so you've got semi-annual coupon bond, you have $50 every 6 months. And there's always a final coupon payment at the maturity as well. So if you hold it until the maturity, you would get the face value, and you would also get the final coupon payment. Okay. And final thing to mention here, so you might wonder how the variable coupon payments work. So usually there is a benchmark rate here. So this could be, for example, something like LIBOR plus 2%. Okay. So then each 6 months or each year, the amount of coupon paid will depend on this benchmark rate plus a markup figure, like 2%, 3%, whatever. Okay. All right. Next up is an important one, which is price and yield to maturity. Okay. So again, let's assume that we are working with a coupon bond, which pays 1,000 at the end. And also let's say it makes periodic coupon payments of $50. Okay. And they start basically from the first period and goes on until the end. Okay. Now you need to pay something for this at the start. Okay. So for example, you pay a price like $990. Okay, just giving you an example. So this means that what you get is by paying $990 now, you get $50 each 6 months plus the $1,000 at the end. Okay, and this doesn't mean that once you buy the bond, you have to hold it until the end. You can trade bonds, right? So this bond is originated here, let's say now, but let's say after 2 years, there'll be 4 6-month periods. So each period is 6 months here. If you wanted, you could sell the bond, right? Or you don't need to buy at the very start. You could also buy a bond many years after it was issued, okay? And of course, the price you pay here won't be necessarily $990. It might be a completely different price. It might be, for example, $1,010. So the bond price is actually dynamic. So over the life of the bond, it will change. Okay. Now, this is the price aspect of it. How about yield, right? So again, this is a fundamental concept in bond valuation, and this is basically the return you would get if you held the bond until the maturity. So, for example, you could compute if you pay $990, and now what would be your yield to maturity if you hold it until the end? Or you could do it here as well. So you purchase, let's say, for 1,010. What would be the YTM? So we usually refer to this as YTM if you hold it until the maturity. And the best thing to think about for understanding YTM is it's equivalent conceptually to internal rate of return, which is widely used in capital budgeting when evaluating investment projects, right? Now, there are a couple of important details here. So, of course, we are talking about the promised yield, right? So it is possible, especially for corporate bonds, that the company, the corporation may default, right? And then there's the risk, this default risk, that the bond payments won't be serviced, okay? For governments, this risk is lower, but still exists, right? So especially if you are talking about a government in economic distress, right? They might struggle to honor their debt payments. The tricks they can use is usually they can either raise taxes, okay, to meet their debt obligations, or they can even print money, right? So these tools are important tools which the corporations don't have. So that's why government bonds are usually less risky. But you have to use these tools within reason. Okay, so it's not like you can always save the day just by using these tools, because, for example, printing money, of course, leads to inflation. Okay, so basically, coming back to yield, so yield is the return you would get from the bond, assuming that the bond payments, the promised payments, are made. Okay, and there is a nice relationship between a bond's price, coupon rate, and yield to maturity. So we would say that the bond is either trading at premium, okay, or at par, or at a discount. And this will depend on the relationship between the yield to maturity and the coupon rate. So if the yield and the coupon rate are equal to each other, we say that the bond is trading at par, in which case the price of the bond is exactly equal to the face value, so $1,000. But in some scenarios, the bond will have a price larger than that. So in this case, it is trading at a value higher than its face value, in which case we say that bond is trading at a premium. Okay, and this would occur, for example, when the coupon rate exceeds the yield to maturity, and conversely, the bond is trading at a discount when the coupon rate falls short of yield to maturity. So let's say our coupon rate is fixed at 10%. So in this scenario, basically, if the yield is also 10%, right, the bond price is at par, but basically you can also think of the yield as a discount rate. But for example, if the yield is 9%, so this means that I'm discounting the bond cash flows slightly lower than its coupon rate, in which case the bond will trade at a premium. Or for example, if the yield is higher at 11% compared to the coupon rate, now the price will fall because I'm discounting more heavily. So this could be something like, I'm just making up the numbers, something like 995. Okay. And I would like to give you a real world example as well, a real quotation of a bond. So the quotation looks like this. And this is a corporate bond issued by the Walt Disney Company with the ticker DIS. And this will mature in 2031. And it started trading in 2020. So as you can see, the maturity is about 10 years, not exactly, but roughly speaking. So this is a relatively long-term bond. It's paying a fixed coupon payment of 2.65%, and it is paid semi-annually. So this means that there are two coupon payments each year. So that means that, from the annual coupon payment is essentially $1,000, right, times 2.65%, which makes $26.50 over the entire year. So that is going to be split into two coupon payments of $13.25. And as you can see, this is not issued exactly at par, but quite close to par. It is issued at a slight discount, and the issue size was $2.5 billion. So basically, Walt Disney raised $2.5 billion by selling this bond to the public. And here's your homework, let's say. So there are a few true or false questions here based on what we have discussed. If you look at the video description, you will find a link to the solutions as well. And the final thing I would like to mention is that if you enjoyed this tutorial, you would probably enjoy our tutorial on bond valuation problems as well. So you can basically try your hand in some exercises to learn how simple bond valuation works. I hope you've enjoyed this tutorial. If you've got any questions, you can, of course, leave a comment, and we'll be looking forward to see you in another video. Bye for today.